Karen from Ohio retired last spring. She had $620,000 saved. She had followed her advisor's advice for 20 years. She had a diversified portfolio, 22 funds, 3 separately managed accounts, and a whole life insurance policy that doubled as an investment. And then the market dropped 18% in her first year of retirement. She called her advisor. He told her not to worry. She kept withdrawing $2,500 a month for living expenses. By year 2, her portfolio was down to $480,000, even after the market partially recovered. She did everything she was told, and she still fell behind. Here's what Karen did not know. There's a specific danger that hits retirees, and only retirees, when the market drops. It does not affect people who are still working and saving. But for someone taking withdrawals every month, a bad few years can permanently shrink a retirement portfolio. The market may recover, but the money you already withdrew does not come back. By the end of this video, you will know exactly how to build a 3-fund portfolio that is specifically designed for the withdrawal phase of retirement, not just the accumulation phase. You will know which 3 funds to own, how much of each, and exactly which one to sell first when the market drops. And the part most people miss, the part that almost no one on YouTube talks about, is the specific adjustment retirees need to make to this portfolio that changes everything. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. The retirement trap nobody warns you about. There is a concept in retirement planning called sequence of returns risk. It sounds technical, but the idea is simple, and it could be the most important thing you hear today. Imagine 2 retirees. Both have $500,000. Both earn the exact same average return over 20 years, 7% annually. The only difference is the order of those returns. Retiree A has good years first, then a few bad years near the end. Retiree B has bad years first, right at retirement, then good years later. Same average return, same portfolio size, same withdrawal amount, but retiree B runs out of money years before retiree A. Why? Because retiree B was forced to sell shares at the worst possible time, when they were cheap, and those shares never came back to help him. He had already spent them. Here is the critical difference between someone still working and a retiree. If you're 45 and the market drops 30%, you keep contributing. You buy more shares at lower prices. That's actually good for your future. But if you're 68 and withdrawing $4,000 a month, that same 30% drop forces you to sell more shares to generate that same $4,000. You're selling low. Every dollar you sell at the bottom is a dollar that cannot participate in the recovery. This is the trap, and it's the reason that the same 3-fund portfolio, built the same way, looks completely different in retirement than it does during the accumulation phase. So how do you protect yourself? That starts with understanding why 3 simple funds beat almost everything else on the market and have for decades. Let me give you the short version of what the 3-fund portfolio actually is. Fund 1, VTI, the Vanguard Total Stock Market ETF. This single fund holds over 3,500 U.S. companies, every size, every sector. Large caps, mid caps, small caps. You own a piece of the entire American economy for 0.03% a year. Fund 2, VXUS, the Vanguard Total International Stock ETF. This holds nearly 8,700 stocks across 40 countries, Europe, Japan, emerging markets, all of it, at 0.05% a year. Fund 3, BND, the Vanguard Total Bond Market ETF. Over 17,000 bonds, U.S. Treasuries, corporate bonds, mortgage-backed securities at 0.03% a year. 3 funds, over 30,000 individual securities, a weighted expense ratio of about 0.04% per year. Now here is why this matters. S&P Dow Jones publishes something called the SPIVA Scorecard, the most comprehensive measure of active fund management in existence. The latest data shows that over 20 years, 94% of actively managed U.S. equity funds underperformed a simple index. 94%. Here's the myth. Professional fund managers have access to better research, better data, and smarter strategies. They can beat the market. Here's the truth. After fees, the typical active manager does not just underperform the index. Academic research shows that virtually none of them produce returns sufficient to cover what they cost. Jack Bogle, the man who created the first index fund, put it this way: "The miracle of compounding returns is overwhelmed by the tyranny of compounding costs." 3 cheap index funds do not just save you money on fees, they almost guarantee you will outperform most professional managers over a long enough time period. The math is on your side before the market even opens. But there's a second problem hiding in plain sight, and it has a specific dollar amount attached to it. Let me show you what a 1% advisory fee actually costs a retiree. Take a $500,000 portfolio. Assume a 7% gross market return, a reasonable long-term average. With a 1% advisory fee, your net return is 6%. With 3 index funds at 0.03%, your net return is essentially 6.97%. That 0.97% difference sounds like almost nothing. Over 20 years, it is $320,000. On a $500,000 portfolio, a $320,000 difference. That is not a rounding error. That is a house. That is years of retirement income. That is a legacy for your children or your grandchildren. On a $1 million portfolio, that gap grows to $640,000. And here is something most people do not realize. Only about 5% of financial professionals are true fiduciaries, legally required to act in your best interest. The other 95% operate under a lower standard. They only need to recommend products that are suitable. That word suitable does a lot of work. A high-fee product can be suitable. A product that pays the advisor a commission can be suitable. Suitable is not the same as best for you. Now, I'm not saying all advisors are bad. Some provide real value, especially for behavioral coaching, tax planning, and estate planning. But for the investment management piece specifically, 3 index funds already do that job better than 94 out of 100 professionals at a fraction of the cost. Before I show you the retiree-specific version of this portfolio, drop a comment right now. Are you still building your retirement savings, or are you already in the withdrawal phase? I read every single comment.
3 myths that cost retirees real money. Myth 1. Bonds are dead. After 2022, the worst year for U.S. bonds in recorded history, a lot of investors swore off bonds entirely. BND fell over 13% that year. It was painful. But here is what happened next. BND returned 5.65% in 2023, another 1.38% in 2024, and 7.08% in 2025, a cumulative recovery of roughly 14.7% in 3 years. Bonds are not dead. The 2022 crash was caused by the fastest rate hiking cycle in 40 years, starting from near zero yields, an extreme and rare event. Today, BND yields over 4%. That's meaningful income for a retirement portfolio for the first time since 2007. Myth 2. International stocks have underperformed, so why bother? For most of the 2010s, this was true, but consider 2025. VXUS returned 32%. VTI returned 17%. International stocks beat U.S. stocks by 15 percentage points in a single year. There's a deeper reason to own VXUS. The top 10 stocks in the S&P 500 now make up 40% of the entire index, an all-time record, nearly double the historical average. Vanguard projects a 70% probability that international equities will outperform U.S. equities over the next decade. Skipping VXUS is not playing it safe. It's making a concentrated bet that the last decade will repeat exactly. History says that's unlikely. Myth 3. Index funds don't generate enough income for retirement. This one surprises people. A moderate 3-fund portfolio, 60% stocks, 40% bonds, generates roughly 2 to 3% in combined dividends and interest before you sell a single share. VTI yields about 1.1%, VXUS yields about 2.9%, BND yields over 4%. On a $600,000 portfolio, that's over $12,000 a year in income before any share sales, combined with a disciplined 4% withdrawal strategy supported by decades of research. This portfolio is specifically designed to fund a retirement that lasts 30 years or more. Here's the bottom line. 3 funds, 30,000 securities, an expense ratio of 0.04%, a withdrawal structure that protects you against the one risk that actually ends retirements, running out of money because you sold stocks at the wrong time. Complexity is what you're sold. Simplicity is what keeps you paid. If someone you know is getting close to retirement and has never heard of the 3-fund portfolio, share this video with them right now. It could change the trajectory of their retirement. Drop a comment below. Which of these 3 myths had you believing it before today? I read every single one. If you're building retirement income and want to stay ahead of strategies like this one, subscribe to Dividend Hustle. I cover everything that protects and grows your income in retirement. Next time, I'm going to show you what happens to a 3-fund portfolio the moment RMDs kick in, and one strategy that can dramatically reduce how much you owe the IRS when they do.